Before a buyer submits an offer in Arizona, they must demonstrate financial capacity. The pre-qualification form serves as that verification tool. In competitive markets, submitting an offer without a completed pre-qualification form is the fastest way to have that offer rejected. Sellers do not evaluate offers based solely on price. They evaluate the likelihood of closing. The pre-qualification form communicates lender involvement, financial screening, and estimated loan eligibility. This document is required to accompany the AAR Residential Resale Real Estate Purchase Contract or Vacant Land Lot Purchase Contract unless the buyer is submitting an all-cash offer with proof of funds. Section 2 of the Arizona Purchase Contract directly ties into this form, making it operationally essential before contract submission. Purpose of the pre-qualification form: establishing financial capacity. The form confirms that a licensed lender has consulted with the buyer and performed preliminary financial review. It is not loan approval. It is not underwriting. It is not a commitment to lend. It is an initial evaluation based on information provided by the buyer. The lender verifies income discussion, asset review, debt obligations, and obtains a tri-merged credit report. This gives sellers reasonable assurance that the buyer has engaged a financial institution. Chandler example. 2 buyers submit identical offers at $525,000. One includes a completed pre-qualification form from a reputable lender. The other states, buyer will obtain financing later. The seller chooses the first offer due to reduced risk. Buyer has not consulted with a lender, rare but possible scenario. The form allows a buyer to indicate they have not consulted with a lender. In that case, only limited signature sections are completed. In practice, submitting an offer without lender consultation is extremely risky and often unacceptable to sellers. Brokers should strongly advise buyers to obtain lender consultation before drafting offers. Reliance on sale of property understanding contingency risk. The form asks whether the buyer is relying on the sale or lease of another property to qualify. If yes, the transaction contains additional uncertainty. Sellers may require sale contingency addenda or reject such offers entirely in competitive environments. Transparency here protects against later disputes. Gilbert example. Buyer needs proceeds from existing home to fund down payment. If that home fails to close, financing collapses. Sellers must understand this risk before accepting the offer. Seller concessions and down payment assistance disclosure. The lender indicates whether the buyer is relying on seller concessions or down payment assistance programs. These factors influence negotiation strength. A buyer needing 3% in concessions may have weaker leverage in multiple offer scenarios. Conversely, a buyer not relying on concessions may present a cleaner offer. Mesa. Example. Buyer requests $10,000 seller concessions, but lender confirms qualification does not depend on concessions. Seller may counter with reduced concession amount while maintaining transaction viability. Loan type and occupancy classification material risk factors. The pre-qualification form identifies loan type and occupancy. Loan types include conventional, FHA, VA, USDA, or other. Each carries different appraisal standards, repair requirements, and closing timelines. Occupancy type distinguishes between primary residence, secondary home, and non-owner occupied investment property. Scottsdale. Example. FHA financing may require property repairs before funding. Seller evaluating multiple offers may prefer conventional financing due to perceived simplicity. Loan amount and payment calculation. Clarifying buyer budget. The lender provides estimated maximum loan amount and projected principal and interest payment. It also sets a maximum total monthly payment threshold, including taxes, insurance, mortgage insurance, HOA dues, and flood insurance if applicable. This ensures buyer affordability aligns with contract price. Important professional note: the interest rate listed is not locked unless specifically indicated. Market changes can affect final loan terms. Lender documentation verification, preliminary financial review. The form outlines documentation received such as pay stubs, tax returns, corporate returns, credit documentation, and gift letters. This signals seriousness of review. A pre-qualification based solely on verbal conversation carries less weight than one supported by documentation review. Loan status updates, ongoing communication requirement. The lender agrees to provide updates using the AAR loan status update form within 10 days of contract acceptance and upon request thereafter. This integrates with Section 2E of the purchase contract. Communication transparency reduces last-minute surprises and helps sellers monitor financing progress. Expiration of pre-qualification time sensitivity. Pre-qualification forms expire, credit reports age, income documentation becomes outdated. Agents must confirm expiration dates before submitting offers. An expired pre-qualification weakens buyer credibility. Difference between pre-qualification and pre-approval. Professional clarity. Pre-qualification is preliminary screening based on buyer-provided information. Pre-approval typically involves verified documentation review and stronger lender commitment. Neither equals final underwriting approval. Phoenix example: buyer pre-qualified at $500,000 but later changes jobs. Underwriting denies loan due to employment history gap. Pre-qualification does not guarantee funding. Broker duty of care and risk reduction. Under AAC R4281101, agents must exercise reasonable skill and care. Submitting offers without verified financing increases risk of contract cancellation and potential complaints. Brokers should maintain written pre-qualification documentation in transaction file pursuant to ARS, paragraph 32.2151.01, record retention requirements. Discussion. Question. Does a pre-qualification guarantee loan approval? Answer: no. Final approval requires underwriting and verification of all documentation. Discussion question: why do sellers prefer offers accompanied by lender consultation? Answer: it reduces financing uncertainty and increases probability of closing. Discussion. Question: what happens if a buyer's financial profile materially changes after pre-qualification? Answer: the pre-qualification may become null and void and loan approval may be denied.